You know, this is an interesting time in energy risk management, in fact, most risk management. With the new administration, changes that affect both the energy and insurance industries are inevitable. Today's panelists will delve into the new American political climate to see how the industries will be affected by the new administration. So let's welcome our panel. First, our first panelist will be Richard Blades, who's chairman of the Worthing Group down in Houston. He's been named a risk and insurance power broker by the Risk and Insurance magazine and has been a frequent speaker here at ERIC. So please welcome to the stage, Richard Blades. Thank you, Richard. Tom Glanson, who's the Government Affairs Officer for AIG, is responsible for their relationships with legislatures and regulatory agencies in multiple southern states. He also serves as the subject matter expert for many property and casualty issues that come up within AIG. So let's please welcome Tom Glanson. Hi, Tom. Next, Kevin Ryan is the Senior Vice President and Chief Financial Officer of Merit Energy here in Dallas. He oversees risk management in addition to accounting, tax, treasury, and the information technology areas. So please welcome Kevin Ryan.
Thanks for being Trip.
Good morning.
Good morning.
So next, Julie Palmer is a partner with Holland and Knight in Houston. She has handled marine and insurance litigation for over 30 years. So let's welcome Julie. Good morning.
Good morning.
So let's get started. So we'd like to start off with a couple high-level questions. So Richard, as a member of the board of the Council of Insurance Agents and Brokers, what do you see the CIAB trying to advance in Congress this year?
Well, Bill, first let me say it's a privilege to be back here again. Thank you for the invitation. So I was in Washington, D.C. for the CIB Legislative Summit back in mid-February. And I got to tell you, it was really exciting in D.C. A lot of fun and had a lot of meetings, different presentations from people. And the key thing people kept saying to us was things are interesting. That it had an interesting meeting, that had an interesting topic, there was an interesting approach, or a new president was going to tackle something. And so what did they have the CIB board members and other people up there trying to do? We were meeting with the congressmen and their staffers. The staffers do all the work. And they write everything and trying to put forward a few items. The first item was do no harm. And that was saying do not tax the employer-sponsored health care. Do not increase the taxes on employee-sponsored health care is the first thing. The second thing was let's reauthorize the National Flood Insurance Program early. And the third, let's make a modification to the Foreign Account Tax Compliance Act, better known as FACTA. Let's carve that out and change that. So those were the three key things that CIB was trying to advance on Congress. Now what I'd like to do, I'm not here representing CIB. I'd like to give you my personal opinion on some of these issues. So this isn't CIB or Wortham's opinion. This is Richard Blades, just what I think. So we need to continue as they go through and whether they modify, repeal, replace the Affordable Care Act, we've got to try to maintain the favorable tax treatment for the employer-sponsored health programs. And why is that? Well, it covers over 170 million hardworking Americans. We do not want to start having taxes erode the amount of coverage people get from their employer programs. And with some of these changes that are being proposed, and it's changing daily, that is a risk. There was a survey done that 88% of Americans that have employer-sponsored health care are pleased with it. It's the segment that's working. The area that's not working is effectively the individual. So let's not attack the employer-sponsored programs with the taxes. Let's address the problem area. Most people are pleased with their health care that they get from their employer. Employers are there to design and implement a program that's going to retain staff. It's going to be favorable. Most people like it. And so that is the key message on that. National Flood Insurance Program renews on September the 30th, right in the middle of hurricane season. How many brokers in this room, raise your hand, if you had an account with major flood exposure, would recommend to your client to move the date off September the 30th or renew it early? Well, I think we would all would. You would not sit there with a big flood exposure and let it go all the way. We've got to reauthorize National Flood Insurance Program early in the year. There's already work being done on that. But it's not just to renew it. We've had problems. It has lapsed in the past. There have been political issues and roadblocks. We want to avoid that. But the other thing is it's got $24 billion in debt. And why does it have so much debt? It's because of the CAT claims. The NFIP is inadequately rated. We've got 96% of us Americans subsidizing the 4% who have this coverage. And so we need to introduce more private capacity and more private use into the National Flood Insurance Program. And we've got to try to blend that out. And I think that's going to happen. That's already been a focus. FACTA. FACTA was a great intention of going after the tax shelters and the tax havens. Totally get that, understand that. They overreached. And by overreaching, they effectively put a big burden on the brokers and the insurance companies that are doing international business. If you don't have the right form and have the compliance, you've got to withhold 30% of the premium back when you pay an international market. Well, in reality, if you don't pay a carrier 100% of the premium, they're going to send notice cancellation to your insured. So you can't do that. So this was an unintended consequence. With FACTA was passed in 2015. There's already a bill being put forward that would exempt non-cash value policies. And so that would be beneficial to the carriers and the brokers because there's a lot of administration, a lot of unnecessary time and effort on that, and it could crimp some international activity. So I think that's positive. So I'll sum up by saying it's going to be very interesting to see what's going to happen this year.
Thank you. Tom, do you have something to add to that?
Sure. I think it's interesting, maybe code for a lot of people to really say they don't know. We don't have a clue. From the beginning of the Trump campaign, they have been disruptors. They've done things in a different way than we are used to. And the reaction is different. I think a lot of us were on autopilot, sort of thinking that we would have a continuation of the Democratic administration and we would know what it would be like under a Clinton administration. Obviously, with the Trump administration, everything is different. A couple of things I want to mention real quickly and try and keep us on schedule. We have to pay attention to FIO, the Federal Insurance Office. We don't know what strength or lack of strength they're going to have under this administration. We have to look at the Department of Labor, who appeared to be emblazoned and was ready to go out and perhaps talk about workers' compensation around the country, and that seems to have lost all of its steam and all the wind's gone out of that sail since the new administration has come in. Dodd-Frank and the regulatory oversight, that's going to impact all the companies as well. Two things I want to close with. First of all, the discussion of the Affordable Care Act may be a saving grace for some of us in the PNC world because it may suck all the life out of Congress and everyone. They may be so tired when they're through talking about that they don't have any time for it. You mentioned flood insurance, and it's sort of a segue into what I want to point out is that the states are still the primary regulator for insurance companies, and we don't know how the administration is going to view their role in overseeing insurance companies. But if they do bring the change to the insurance industry, that's going to require a lot of support from the states, and we'll have to see how that plays out.
Any other comments from the panel on insurance? Well, then let's move to the energy sector. So, Kevin, what are your thoughts about the potential changes going on in Washington, D.C. that will impact your business?
Well, the lobbyists and energy trade associations are very busy. IPAA, API, Texas Alliance, just trying to gather some information, meeting with representatives, trying to get a feel for what's going on. As an oil and gas company, we're very excited about the agency appointments and department appointments. They appear to be very oil and gas friendly. Rick Perry, Department of Energy, Texas, oil and gas friendly state. Ryan Zinke from Montana, Department of Interior, he actually has said that climate change is not a hoax, which has kind of been against what, or contradicts Trump. And then EPA, Scott Pruitt, the ex-Attorney General from Oklahoma, again, another oil and gas-friendly state, who has stated that he thinks there are too many regulations. He'd like to reduce or eliminate a lot of the regulations out there as kind of as a general theme. As an oil and gas company, we're trying to understand the Trump administration, what is their energy plan? So if you look to the website, the America First Energy Plan, and per the White House website, it states that eliminating or reducing all of these regulations will increase wages by over $30 billion over 7 years. Not sure where he got that number. That's a big number. In that same website, he also states that there are $50 trillion of untapped oil and gas resources. Again, not sure where he got the number. That's a big number, but that's awesome. He may have to tap into some of that $50 trillion in order to pay for the $1 trillion worth of infrastructure projects that he wants to do, but maybe we'll talk about that a little bit later. So again, as an oil and gas company, what is this America First Energy Plan? What are the goals? Well, states they want energy independence, undo Obama's climate action plan, exploit fossil fuels, specifically coal and oil and gas, and hope to create a lot of jobs, right? That's the goal. To give you a little insight as far as where I'm coming from with Merit Energy Company, a little bit about our company. We're a private oil and gas company, upstream, dealing with mature producing properties. We've got about 10,000 wells. We operate in the U.S. only, 10 states. We used to have Canada, used to have offshore, have since gotten out. A little over 70,000 barrels of production a day. We do have some gas plants, some processing plants, some pipelines. And we operate in federal lands, state lands, and tribal lands. So our perception so far is a lot of talk about a lot of change. We'll see what gets done. That's going to be the tough part, how much will actually get done. Trump obviously can't do it himself. He needs Congress. So we're trying to get some cues as to what Congress is talking about. What do they think they can get done in a timely manner? So, but as an industry, we can't wait. We've got to move on. We've got to focus on producing. We've got to focus on getting energy sources and, again, kind of providing jobs. So end of the day, economics works. We'll continue to do what we do. And hopefully we have enough lead time when there are some changes, especially significant changes, that we can kind of react and adjust our business accordingly.
So, Richard, what are you hearing from your energy clients?
So, it's interesting. Depending on what happens and what the administration is able to push through, we're going to have some winners and losers. We may have people excited about the economy. We're going to have increased infrastructure along the Gulf Coast. And if we have increased infrastructure spending, it's going to be good news for underwriters and for brokers. We're going to have more builder's risk, OSIPs. It's going to increase payroll, workers' compensation. And so that's going to be good for the insurance market. On the other side, if we go to more protection and we stop having as many exports, I could see a decrease in the need for some of the marine coverages. Some of the cargo may not be needed. And so we may have some winners and losers depending on what Trump and the administration is able to push forward. I think another thing that we need to keep in mind is interest rates have been at historically low levels. As we start having interest rates rise, what is that going to mean to the insurance market? Well, there are a couple of different things that could happen. One, we've had a flood of capacity come into the market since 2009. The policyholder surplus in the United States has gone up over 50% since 2009. And one of the reasons of that is because the recovery in the stock market, but you've had a lot of people looking for returns with the low investments. And so capital has gone into the insurance business. So when you get interest rates going up, will some of that capacity, some of that capital that's been in the insurance market go to other areas where they're going to get other returns? Maybe that will take some of this excess surplus out. The other side of it is, we've all been in underwriting meetings. Underwriters saying, I've got to make an underwriting profit because I'm not making an investment return. Interest rates are so low. So when interest rates start going back up, what is that going to mean? Well, the argument would be is you don't have to make as much of an underwriting profit. You can lower the rates because you can cash flow underwrite a little bit more because you're getting good return with the higher interest rates. So I think something to watch with the insurance market is these things change is going to be what interest rates do to those two dynamics. Now, Bill, talking about some of our clients, I'm talking to our onshore clients. They're looking at it and going of a $45 to $55 price range for oil. They can make money, especially with the new technology and the service costs coming down. And so we're seeing a lot of optimistic. Now, don't get me wrong, they still want rate reductions. They still want a lot of competition, save money. Everybody's still being very cautious. And we are starting to see more mergers and acquisitions, especially if you've got something going on in West Texas. And so a lot of enthusiasm. People feel a whole lot better today than they did 13 months ago when we were down to the very valley in February of 2016 on prices. So that's exciting. Our offshore clients in the Gulf are absolutely thrilled. You all, for those of you who were here last year, I put up a couple slides warning you about the Bureau of Offshore Energy Management and the fact that they were going to start, you had a notice to the leaseholders out on the shelf that they were going to have more surety requirements for the decommissioning of offshore platforms. Well, that was accurate at the time, and that has changed. As of last month, the Bureau of Offshore Energy Management has said they're going to suspend that ruling, and they're going to have 6 months so the new administration can review this. And I think that's welcome news to the offshore offshore E&P companies who've been under a lot of pressure not to have to do that incremental collateral and surety requirements for the Gulf of Mexico. BOEM did leave an out where they can effectively come back and say if they consider a significant risk. And don't forget, there has been a big bankruptcy where the U.S. government did get stuck for a big issue out in the Gulf of Mexico before, so it is an important issue, but I think it's good that the administration is going to review that. Other thing that I've said before this conference is during the downturn, you need to right-size your program. You need to look at your current exposures. You need to modify it, otherwise we'll work with you midterm. Well, let's not forget that concept. We need to be nimble here. Things are going the other way. And so let's say, for example, in the downturn, crude oil prices were down. You've got an offshore platform. The field reserves aren't that big at $20 or $25 a barrel in oil. And so maybe you insure it for just removal debris. You don't insure it for the full value because you wouldn't put it back at $25. Well, that decision process perhaps has changed. The same with some of your business interruption values and looking at some of your facilities. So my message there is don't wait until renewal. If the commodity price is going back up, let's go back to your underwriters now. They'll be thrilled to add more coverage in if you need it, just like they worked with you when things were going the other way. And we're going to have other curveballs thrown at us with this new administration. Don't know exactly what's going to happen. If you're a risk manager, be ready to adapt and make changes as you go. And I think the other thing is crews come back to work. I think some of the service companies have all the equipment in the world. I don't think they're going to have the crews. And so I'll rephrase that. They're not going to have the experienced crews. So make sure that the people that are doing the work for you are going to train their crews and have them doing the right safety procedures. We don't want to see another uptick in auto claims like we saw when crude oil was $100 a barrel just because they had anybody off the street driving. And so I think as we go back up, let's learn from that lesson.
Julia or Tom, you have a comment?
Just one comment I'd like to add is all of the administration's activities seem to be focused around creating jobs, and that's certainly an admirable thing to advocate. I just think there needs to be a little bit of a reality check that every policy does not automatically translate to the creation of jobs. It goes back to the winners and losers comment that Richard made, but some of the policies are good, but they don't all generate jobs.
Yeah, especially, we're seeing more activity in putting in robotic equipment, which even though you have an uptick in operations, you still have a downtick in the amount of labor required. Julie, you have anything to add?
Well, the next topic we were going to talk about really rolls into this, and that's the protectionism. America First is based on a protectionist theory that we need to protect American jobs, we need to protect American opportunities, and it really is a mixed bag of winners and losers when you look at that. One of the things that we expect from the offshore realm is we expect enforcement of the Jones Act. And this is not the Jones Act that you talk about when you look at personal injuries for seamen, but the Jones Act that relates to our cabotage laws that prohibit foreign vessels from coast-wide trade in the U.S. Now, you wouldn't think of that very often, save and except for if you're in the oil and gas industry and you're looking at specialized equipment that you need that's under a foreign flag, but you can't bring it into the U.S., take it out to a site and bring it back into that U.S. port. You're not going to be able to use it. So it forces you to use U.S. vessels. So there had been some liberalization of the Jones Act. I expect that will change and that we will have a more stringent enforcement of the Jones Act. With regard to the export of petroleum products and Trump wanting to open up markets, open up the opportunity where it has been protected in the past, back when we were worried about will we have enough to supply the U.S., you may see requirements that be on U.S. bottoms. In some countries where they enact this type of protectionist legislation, they also require U.S. insurers. So, for example, if you were dealing with Brazil, they're going to require Brazilian bottoms, require at least Brazilian fronted insurance, much the same way Mexico often requires Mexican fronted insurance. So there's some opportunities, I think, for the U.S. marine market that we are dealing with. The $1 trillion in infrastructure that has been proposed by Trump, a lot of that has to do with port projects. Port projects are very important. There's something that are ongoing. If you dredge a port, I can guarantee you're going to have to dredge it again. So it's work that is ongoing and needed, and a lot of our ports need that money. However, if you're talking about protectionist trade and pulling out of NAFTA and pulling out of some of the other trade agreements that we have, or restricting trade with Cuba or not trading with Iran or other countries, now you're looking at less trade and less opportunities. Well, the Port of Houston is usually number one in tonnage in the U.S. There's a huge number of jobs created by the trade that comes through the Port of Houston. So preserving that port, yes, it's important to build the infrastructure and jobs with that, but it's also important that we have that open trade in order to be able to bring in goods from other countries. That's quite important to us. Now, the other thing that we're dealing with ports, even though we're talking about infrastructure, Trump has also proposed a $1.3 billion cut in the United States Coast Guard. There's a $54 billion increase in overall spending or proposed spending for the military, but that includes a cut to the U.S. Coast Guard. Well, the U.S. Coast Guard does a great deal of work to ensure our security. They're part of Homeland Security. And they're also involved in immigrant intervention, drug intervention. And they also do basic important things like run an icebreaker that keeps the Great Lakes open. So the Coast Guard is a very important component, and if we don't have those Coast Guard resources, again, you start seeing the losers, and that may be on the U.S. Marine side. With regard to trade policies, there's been a great deal of talk about restricting trade with Cuba and with Iran. Now, with regard to Iran, there's not the hue and cry to establish that trade. But with regard to Cuba, Trump's supporters in the Midwest, the agribusiness, they want to be able to sell product to Cuba. They want Cuba as a trading partner. Likewise, the oil and gas industry would like to have the opportunity to do exploration in Cuba. So those, again, we start looking at, with the protectionist attitude, who are the ultimate winners and losers in all of this. Finally, with regard to pipelines, Trump has indicated that he is very supportive of pipelines, particularly the Keystone Pipeline, but he's not in favor of NAFTA. Interestingly, TransCanada, who is building the Keystone Pipeline, has brought a $15 billion NAFTA claim against the U.S. So there's a real issue here as to how all of this works together. Finally, pipelines, there's been an executive order that pipelines have to be built with U.S. steel. I'm not sure we have the capacity to do that. It would be great to have steel mills running again, but if what we want to do is push for construction of pipelines, if we're doing it only with U.S. steel, then we have created a problem. So I think there are going to be a lot of changes. A lot of winners and losers, and it's going to be a very dynamic time for both the marine and energy business.
Well, thank you. So, Tom, what's your viewpoint from a governmental office affairs person?
Well, a couple of things. First of all, I agree with a lot of what Julia said. Ports are just a machine, essentially. They need to run efficiently. They need to create jobs. They need to keep people employed. Hopefully, with some policies that are in place, those ports will be busy doing exports for the U.S., not just imports. And I think there's been a real imbalance. If you look at the ports, from what I understand, not my area of expertise, but ships would come in loaded and leave empty. And so hopefully there'll be more going out than there is currently. But a couple of things, and I'm going to be sort of brief on these, is that as policies change, people change. We don't know what the reactions to these policy changes are going to be. We don't know what the reactions from other countries that we do business with may be. People that have been our friends may not be so friendly anymore, and people that were not friendly may be friendly. We don't know how this is all going to shake out. A couple of things that come out of that from my perspective is that you have to continually evaluate your exposure. And I'm sure good risk managers do that on a routine basis, but I think you're going to have to be really, really on the ball and pay attention to what's going on globally and how these policies play out, because it may impact you indirectly and it may come in through the back door. You've really got to be a savvy consumer.
Kevin or Richard, do you have any comments on that subject? Well, let's talk about labor force and regulations. So, Tom, again, from your viewpoint, what bearing will the administration's policy on illegal immigrants or undocumented workers have on the labor force? And will promise of less regulation really result or actually result in more jobs?
Well, I think we're in some really interesting times. Texas has enjoyed a lot of economic prosperity since 2009. We've had a booming economy. I think that gives those of us in Texas a somewhat looking through rose-colored glasses view of the rest of the world. As Julia pointed out, middle America, they're still looking for jobs. The prosperity hasn't extended to all of those. And the small town that I came from out in West Texas probably hasn't enjoyed as much economic prosperity as those of us in some of the more major metropolitan areas. So our workforce there are a lot of people that really want jobs. We hear a lot about the Trump's administration policy on immigration and building a wall. We hear about, exporting people who are here illegally, and we keep getting refinements on it. We don't know what that means. But also, the numbers that you hear quoted about the number of undocumented workers that may be in the United States is all over the page. And I didn't realize I went out and counted them. I think everybody's just guessing. So we really don't know how many undocumented workers are here. But with the threat of deportation, that's straining these workers. They're, what I believe is that they will be afraid to get medical care through workers' comp or something like that. As Richard pointed out, they may just show up at a hospital emergency room and then become somewhat of a tax burden for us. We pay for that. Some of these undocumented workers that may leave voluntarily are leaving gaps behind. Our clients tell us that some of these undocumented workers are used, they don't want to and they try not to do so, but these businesses have jobs to be done and they can't get, quote, American workers to come in and do the work. The American workers don't want to do some of the dirtier, more manual work that these undocumented workers do. So are we going to have enough workers to keep our economy going? I don't know. I think that's a question we have to ask. And there seems to be also, in my mind, a mentality that the immigrants have taken a lot of American jobs, and certainly immigrants have taken a lot of jobs. But I think there is sort of a denial in many aspects that technology has taken many jobs as well. We alluded to that earlier, but many of the ports are highly automated. There's not all those longshoremen there unloading the ships now. They're done by robots and very automated ports. And I saw an article just earlier this week that the Boeing company, with their new generation 777, almost the entire fuselage is being built by robots. How many people lost their job because of that? So as we're talking about immigrants and the jobs they've taken, maybe leaving the country, if they leave the country, some of those jobs may be replaced by technology, by robotics. I think closing it, that if they do leave the country, there will be more and more technology introduced to replace those jobs rather than humans to replace those jobs.
Do you have any comments?
I do. I'm reminded by an article that I read several years ago about China. It was when China got involved in the rose growing business. And they did an analysis of whether it was more cost efficient to cut off the thorns with a machine that could do it, or to hire people to cut the thorns off, because you would save money in the shipping by literally cutting the thorns off the rose. And they found it was cheaper to hire people, because the technology, even though it was cheap, the people were cheaper to do that. And so I think your comment about some of these jobs being replaced by technology is very accurate. The undocumented worker, even if your company, my company, the Fortune 500s aren't hiring them, to be honest, at some point in the chain, they are hired by a sub of a sub of a sub, and they are part of what makes things work. And I know in Texas, it is probably more obvious than it is in other places. So when we have that workforce eliminated, are we going to be dealing with disruption? Are we really going to replace those jobs with people taking those jobs, or are we going to be looking at technology? One of the other labor issues we're dealing with in the Rust Belt, I came from the Rust Belt. I was born in Dayton, Ohio, in a town that had 5 General Motors plants, none of which are there anymore. They're all gone. The United Mine Workers have been very active in talking about bringing back coal. Coal needs to be developed, is their position, even though it has been in large part replaced by technology and newer and cleaner methods. But the United Mine Workers Health and Pension Plan is near insolvency. It will go broke very shortly. And there's a question is, will the Republican Congress bail out the United Mine Workers Pension Fund, or what is going to happen with that? And at the same time, you've got the Trump administration. The proposed budget from the president is recommending a cut of $18 to $20 billion from education, labor, and health programs. So again, I think we're seeing a mixed bag of winners and losers, and not real clear answers as to what will happen in the next 4 years.
Thank you. So, Kevin, we might move to environmental deregulation. So what deregulatory trends are you seeing with respect to environmental issues that will impact the oil and gas industry, and what are the trade-offs associated with those trends?
As an oil and gas company, we're, again, very excited about Scott Pruitt being in charge of EPA. Oklahoma, he's publicly stated that too many regulations, we need less regulations. He understands that a lot of the regulations are burdensome, not practical, and in most cases maybe aren't achieving the goals that they set out to achieve. So the trends we're hearing, easing regulations, making it easier to do business out there. And that all sounds good. Again, if that means more drilling on federal lands or offshore, easing of the greenhouse gas emissions monitoring and tracking. Right now we've got a couple staff folks. We have a software package we had to buy. We have to keep track of, on location, 10,000 wells of all the emissions everything. This gets reported to the states then report it to the EPA. And we've been doing this for years. We haven't heard any feedback. We're not sure how it's being used, why it's being used, but we still have to spend the time and money to collect all this information. It just seems like a waste. Well, sure enough, just last week, Scott Pruitt, EPA, announced that that emissions information request is being canceled. And not only are oil and gas companies happy, but also a lot of the states are happy too, because they were spending a lot of time and resources providing that. So that's a first step as far as maybe reducing some of these regulations. Hopefully, quicker permitting for doing drilling or doing working on drill wells. Also, greater clarity between federal and state regulations. Sometimes there's an overlap, sometimes there's disputes as far as kind of who has jurisdiction, so it'd be nice to kind of have a little bit of clarity. Maybe easing of some of the water management issues related to frac fluids, disposal wells would be nice. Air quality standards can be burdensome, not practical. We just need some more effective regulations. And you could tell that a lot of these regulations have not been written by somebody in the oil and gas business that understands the oil and gas business. And so it'd be nice to have some input to help create some regulations that make sense, that are effective, and not just busy work or burdensome. Now, as an oil and gas company, most oil and gas companies, we want to be good stewards of the environment. We want clean air, we want clean water, we want a clean environment. Our field folks live and work in the field, and so they want clean water and clean air because they live there. But there are trade-offs. And, we don't want to drill in Yellowstone National Park, but there are some federal lands in very remote places that aren't very pretty that probably could be opened up for some drilling. Regarding climate change, yes, the climate is changing. It has changed and has been changing for millions of years. I think what is alarming, obviously, is the rate of that change and the extent of that change. And if there are some things that we can do from an emissions standpoint and fossil fuels to stem that those extremes, then yes, we should do some of those. But if the trade-off is using less fossil fuels, then we need to be ready with some other fuel sources to provide the energy that we need. Currently, 2/3 of our electricity generated in the United States is by coal and natural gas. So if we're going to start decreasing that, well, we need to have some other sources ready to go. And we need to kind of work on that transition. And I would think that any sort of energy policy that gets designed needs to kind of help with that transition between the energy sources that we have. From an insurance perspective, we deal with mature producing properties, and yes, sometimes there are leaks, sometimes pipelines break and spills. And we've got, because we deal with, again, mature producing properties, to manage that, there are a lot of insurance products out there to help us. Some gradual spill, some accidental spill, and so we employ a lot of those measures to kind of help mitigate some of that risk. So there are some good insurance products out there.
So from a legal perspective, do you have any thoughts, Julie?
Well, I think you've got a lot of good news coming in terms of the regulation. One of the executive orders that President Trump has signed requires that for every new regulation to be cut. And so it's an interesting way of dealing with it, but I think it is effectively moving forward in terms of cutting regulations and certainly making people go through and look at and find what regulations we really don't need and can be eliminated or certainly can be approved. President Trump's budget proposes a 25% cut to the EPA. That is very, very significant. It takes it back to like 1980s levels of funding. So we're expecting very significant cutbacks to the Corps of Engineers. The Corps of Engineers and the EPA work together, particularly when you're talking about onshore in marshlands or immediately offshore in terms of permitting in the federal government. So, they sort of work hand in hand. We expect repeal of the Clean Power Plan that was put in place by President Obama. The Clean Power Plan expanded the EPA beyond the Clean Air Act. The other thing that I saw in the last couple of days is there are regulations regarding flaring are going to be rolled back, and that will be quite significant. They expect the repeal of Obama's Waters of the U.S. Act. It was a very technical piece of, I believe it was an executive order, but what it did is it defined the EPA's jurisdiction over water and greatly expanded the EPA's jurisdiction over water. So the clarity between state and federal government, I think, will become clearer. With all these changes, what do we expect in terms of pushback? We expect that there will be lots of litigation in the courts trying to figure out what applies, what the EPA's true purview and jurisdiction is. It'll be interesting now that we have someone from the energy sector heading up the EPA as to what the EPA takes on. The EPA in the past has been very proactive. That may change, and so you may see more private litigants trying to raise some of these issues as opposed to the EPA. So I expect it will be very litigious, and I expect that we will see cases in the U.S. Supreme Court.
So, Richard, how does this impact the insurance industry and its clients?
Well, just to touch on the insurance side a little bit, of course, there's a lot of uncertainty depending what happens with the new regulations. But I think the other thing that's going on is there have been some changes in the environmental market. People know AIG changed their position on the environmental. We've got aging infrastructure. We can call it mature or we can call it old. We've got some old properties out there, and some of the assets need to be underwritten closely. And the result you're going to get on your renewal for environmental is going to very much depend on your assets, how you present it, how you communicate, all the things you've done to make your mature assets a better risk for underwriters. I think it's very important in this class of business to start early, have your homework done in advance, have the details, and be able to communicate to the underwriters why your mature assets, why your aging infrastructure is still a good risk and what you've done, and why you've replaced certain pipes and things of that nature. There are fewer markets doing the primary layers, and they're trying to reduce the amount of limit they're going to give out on the primary. There's ample capacity on the excess. You can still build up very nice limits for the gradual pollution coverage. They may want slightly higher retentions, or they may want more sudden accidental pollution underneath them, but you have adequate limits, especially for the midstream and downstream business. E&P may be a little bit tougher, especially with some of the press that's been going on. And so I think this is we've seen over the last handful of years more E&P companies buy the environmental coverage to augment their traditional programs, their traditional operators extra expense and sudden accidental pollution, their casualty programs. So highly recommend, look at the environmental, start early, have your facts together. You may not buy it on your entire asset base. You might buy it just on certain specific ones, but make it part of your risk management program.
So, Richard, I've seen reports that energy insurance premiums are sort of been on the downslide. So do you think these changes are going to affect pricing to any great degree?
So it's interesting. We've seen significant rate reductions the last few years for a couple of reasons. One, the lack of catastrophe claims. We've been running below the 10-year average for a number of years. They ticked up a little bit in 2016 on the cat losses, but still, with the ample surplus capacity coming into the market, not having the cat losses really since 2008 in the Gulf of Mexico, rate reductions are still readily available. Now, that's not necessarily true in auto. Auto is a little bit firmer. And what I'm seeing so far this year is the rate reduction that we're getting from underwriters in most cases is not quite as big as the rate reduction we got last year. So we're starting to see the pace of rate reductions ease up a little bit, and it's going to be interesting to see, we're going to start rocking along the bottom of the market, I think, at some point, and it's time to perhaps look at multi-year deals. If you're a buyer, you might want to think about a 2-year deal if you can get favorable terms. The market's got a lot more room, to go up than it does down if we have catastrophes. But I think it's going to take more than one catastrophe to really change this market. It's just been soft for so long. How much further it can go down remains to be seen.
That's a great take-home point. So, Tom, let's move into talking about the growth of the energy industry. Alternate forms of energy such as wind and solar are reducing the need for traditional fossil fuels. Autos, jets, buildings, factories are becoming more cost or energy efficient. Given this trend, how much room is there for the energy industry as we know it today to grow? And will we reach a point where we're producing more energy than we can use here in the U.S.? And what steps do you think the government would take to deal with that?
If I may, I'd like to address that, but I'd like to just comment on
okay,
Richard real
great.
quick, if I could.
Please do.
Just a couple of things on the regulatory trends. Taking it a little bit out of the oil and gas, but current administration has talked about rolling back a lot of the EPA requirements that impact the coal industry. They want to bring coal back to a certain degree. The state of West Virginia predicts that if all the onerous regulations in that state are removed, they can get coal back to a major industry in that state. They're still going to lose a net 2,000 jobs in the coal industry, even with the rollback of those regulations. So with my mantra of this presentation, everything is supposed to be tied to jobs, and it's not necessarily creating a job, every one of these individual things we're talking about. I wanted to just mention real quickly, Julia's the 2-for-1 on the regulation piece. I think that is so fun. It sounds so great, but regulations aren't standalone. They all sit on top of each other. And so if you create a new regulation and get rid of two, it looks like less, but it may create so much ambiguity that lawyers are going to be, it's a full employment act for the legal community, because there's going to be a need to clarify.
Yes.
People need clarity. Businesses need clarity to do their business before you will invest money, before you will grow or shrink or whatever. So it sounds great on paper, but I don't know how well we can deliver that. And last thing I'll say, and then I'll go to my assigned question, is that, again, back to my mantra on jobs, so many of these things that we're talking about that the Trump administration has put forth are supposed to create jobs. And we saw in the election that the Trump message changed the base and gave him a huge base in middle America and people that were forgotten by the Democratic Party. I personally believe, not my company, but my personal thoughts are that that base was motivated by the Make America First. It will create jobs. It will put us into a better position in the world. If those jobs don't materialize, if we don't see a lot of jobs going to those people who are currently unemployed, I think that in 2 years, we're going to have to, the Republicans who are currently in charge of everything may have a comeuppance. I believe Barack Obama used the term shellacking. And it may be time, we might see a shellacking of the Republicans in a couple of years. It's some of these policies that were so designed to improve our economy and create jobs don't come true. So now I'll go into my assigned question. The alternative forms of energy, and I apologize for rattling there.
Great points. Thank you.
I travel a lot, and primarily by air. It's impossible to look out your window on an airplane these days, I think, and not see a wind farm. You'll see those big, huge turbines over the sides of mountains in places where I didn't think there was enough wind to generate any energy, but they're there. They're covering the countryside, generating a lot of energy. I was in Hawaii, and I couldn't believe how many homes and businesses had solar panels on the roofs there. Other parts of the country, the same way, you're seeing that. So there are a lot of forms of energy that are being harnessed these days besides just the fossil fuels. And I believe Mr. Perry has expressed support for those industries, all the alternative, as we call them, forms of energy these days. And as you pointed out, everything is becoming more energy efficient. So I think you have to ask the question, do we eventually generate more energy than we need? And a couple of responses I have on that is that everything that we do today needs electricity. And one of the most efficient ways to generate electricity is still natural gas. I believe that these alternative forms of energy are going to be generating electricity for us to use as well. And I think that we are going to continue to find ways to use energy. And part of it may be part of that is introducing technology in our plants. People don't use so much energy, but those robots that are building the 777 are going to use a lot of energy. So I think our energy demands are going to continue to grow. I think we're going to find some alternative ways to provide some of that energy. But I think there's still a very robust market for the fossil fuel industry. I don't think they're in danger of extinction like the dinosaurs that maybe created the fossil fuel industry. But I like the term net exporter. I mean, I think it would be great if we got to the point in the energy world where we could become a net exporter. And with the growth of other countries, these developing third world countries that don't have the infrastructure to generate their own power, that do the drilling, et cetera, I think there's some great opportunities for us.
Well, in fact, we had built many LNG facilities for importing LNG, and we're flipping all of them. Right now in Houston, we have multiple facilities that are now exporting LNG, so that has come to fruition. But for the shale gas boom, we would not be doing that. What was interesting is when Deepwater Horizon happened and we had the offshore moratorium, everybody had a budget, and you need to invest it, you need to do something with it. And so we saw the investment move onshore and develop what was rather a fledgling effort to develop shale gas before Deepwater Horizon. We saw a great amount of investment, and what it's turned into is we now have surplus to turn around and flip all those LNG facilities and export.
I'll chime in. Working for an oil and gas company, you probably have an idea of what my feelings are on alternative energies. Wind, solar, and hydro, those are localized energy sources. They're great for whatever country is using those. And currently, those three sources actually supply about 13% of the energy source for electricity, to generate electricity. And that number is increasing every year. If you look on the demand side, as the U.S. consumes less fossil fuels, as we mentioned, there's still a lot of undeveloped countries that will develop. Think Africa, and they will need a lot of electricity, a lot of energy to develop as they continue. And initially, what makes sense is to bring in the fossil fuels. It's cheaper, it's quicker. There's global sources of it. There are mobile sources of it. You can deliver the oil, you can deliver the LNG, you can deliver the sources there. And then maybe later on, you transition the solar energy or the wind energy as the infrastructure kind of builds itself out. The EIA, the Energy Information Administration, has projected that world energy consumption, the demand, will increase 48% by the year 2040. So world energy consumption is increasing. That's the demand side. So if we flip to the supply side of that, U.S. is continuing to expect to increase production, fossil fuels. So I think we will become a net exporter. In fact, the EIA, again, in their 2017 annual outlook, projected, depending on what scenario you believe, that we will be a net exporter by either the year 2020 or 2050, somewhere in between there, again, depending on what scenario. Just the fact that they're saying that we could be a net exporters is something that's, wasn't talked about before. So we'll be competing with a lot of other global companies and countries who also have sources in transporting that. But they're mobile sources. Oil can be transported, obviously, via tanker, LNG via tanker, pipelines, Canada, Mexico. And if you're into Mexico, you can go to Central America, maybe even South America, assuming we haven't angered all the other countries and that we're actually doing work and doing trade with the other countries. But I think there's a trade-off there, and that is energy security. Do we want to produce all this energy and export it out, or do we want to save some in case we need it, in case of an emergency? That's something we've got to think about. And if so, how much do we save? The SPR, the Strategic Petroleum Reserve, 700 million barrels, that's only going to last a matter of months from that standpoint. So I think that trade-off is energy security. I'm not sure where we take that. But economic works, and we're going to continue as an oil and gas company to produce and make a profit, hopefully, from producing fossil fuels. And until the government steps in to say, no, we're going to incentivize you or disincentivize you to reduce your production in the name of energy security. So we'll see.
Any other thoughts from the panel on that subject? I guess, one thought is that, from a storage standpoint, if supply, is less than the demand, prices go up, and then you can tap a lot of reserves that are not economically feasible at this point in time.
Right.
So that, in a way, is sort of a reserve in itself, right?
Yeah, we've got a lot of reserves just sitting in the ground. And as Trump said, there's $50 trillion worth of oil and gas reserves just waiting to be tapped. So, but yes.
Well, Kevin, since taxes are in your wheelhouse, and there's a lot of discussion being discussed about changing taxes, do you expect significant tax regulatory changes for the oil and gas? And if so, how would that impact your business and maybe even your funding?
Grab some coffee. We're talking about taxes here. So. And I realize the tax code, really is a mystery to a lot of people. It's sometimes a mystery to me, and I'm a CPA. But I still remember my very first tax class in college 30-something years ago. And before we got started in the book, the professor said, the purpose of the tax code is to achieve the socio-economic goals of the government. Provides incentives for things they want to incentivize us with and penalties for things they don't want us to do. And depending on whatever the current administration, the current government, the current goals are. And that's one of the reasons for the complexity of it is over periods of administrations, periods of times, different goals, different things get added here or there. It's kind of hodgepodge. And you have this one big, huge kind of web, if you will, of complexity. If you look at the current tax incentives for oil and gas companies, the perception out there, I think, from everyone is that we get a lot of free stuff. We don't have to pay taxes, we get a lot of free stuff. Basically, what we get is an acceleration of tax deductions for the capital we put back in looking for more energy sources, providing more jobs. It's that incentive for us to spend money and to continue to spend money looking for those sources. It's a risky business. And so the government needed to provide an incentive, and they did this through the tax code. It's also the reason why there's tax benefits for solar and wind. Those are risky businesses. They need to get started, and so the government provided that incentive. Again, all the government's trying to do is provide energy sources and jobs for a growing economy. Now, when oil prices are high, as well as gas prices are high when you pump your car up, everyone's complaining about how much the oil and gas companies are making. That's when you start talking about windfall profits tax, excess earnings tax. The oil and gas companies are making way too much money. But what doesn't show up on that income statement that everyone sees as to how much money we're making is the capital dollars we're taking and funneling back in to the business, reinvesting it, again, looking for additional sources of energy to provide for a growing economy as well as jobs. Prices are high because demand is high. And during these times, the world consumes a lot of energy, and that's why that demand is high, and that's what keeps the prices high. With all that spending going on and all the acceleration of tax benefits, it appears that we never pay taxes. It just kind of continues on. And for some companies, that's true. But end of the day, we do pay our fair share, when either the asset's sold or there's some sort of transaction. End of the day, we will pay our fair share in that. Don't worry about that. For Merit, we're a more conservative company. We deal with mature assets. So we're only spending about 25% of our cash flow, putting it back into capital projects. But if you look at an exploration company, it could be anywhere from 80% to 120% of their annual cash flow that is going back in looking for more energy sources. Again, money being plowed back in, creating jobs. Now, recently, though, right, we've seen when prices come down. It's not good for the economy. There's no capital being spent. Jobs are lost. Other than it's great for the gas prices and you go pump gas in your car. And then, of course, the other thing that goes away are the complaints that the oil and gas companies are making all this money. But again, socioeconomic goal of the government, growing economy, jobs, and this is why we get the kind of special tax treatment. Now, what people don't realize is we get taxed in a lot of other ways. Remember, we're on federal, state, and tribal lands, and believe me, they want their piece of the pie also. So severance taxes, ad valorem taxes, sales use taxes, business taxes. We get a lot of taxes that aren't seen by a lot of folks, but everyone takes their fair share. Now, taxes for the oil and gas industry may be changing in a very big way. We'll see. Trump, again, $1 trillion worth of infrastructure. You need to pay for it somehow. So maybe wanting to tap some of those $50 trillion worth of oil and gas reserves and tax that to help pay for the $1 trillion of infrastructure. In fact, there was an article just last week in the Wall Street Journal basically saying, just that. The other tax that's been talked about is the border adjustment tax. It's come up. It sounds like it's probably not going to get passed. And this tax is actually bad for oil refiners. What people don't realize is our oil refiners, they deal with kind of more sour or heavy crude. So a lot of that has to be actually imported in. And if there's going to be a 20% surcharge on that imported oil so that we can make gasoline and diesel and jet fuel, well, most likely, all, if not some of that is going to get passed on or passed through to the consumers, you have to imagine. Now, with all the talk of tax laws changing, only Congress can change the tax law. Trump can't do an executive order to change the tax law. And I really think right now the Republicans are having a difficult time trying to figure out and get on the same page as far as what they want to do. Now, if the oil and gas industry is taxed more heavily, let's say we lose some of those incentives to delay the taxes, what would happen? Would we stop investing? Would we no longer look for oil and gas? No. Economics works. We're going to still do that. There may be a slowing of some of the projects. There may be a slowing of some of the deep, risky offshore projects. There may be a slowing of some of the research and development work that goes on to help, but it's not going to stop. It'll continue on. It's not going to stop. Now, economics works, so if production of oil and gas slows down and supply and demand increases, we've all taken economics, then what happens? Well, oil prices go up, which could mean gas prices go up, electricity prices could go up, jobs could be lost. That's going to have a greater push for more alternative energies when prices are high. So, you have to take a look at that. Now, what I haven't admitted is how's that going to impact merit as far as taxes goes. Most of our investors are actually tax exempt. The university endowment funds and pension plans, and we do this through partnerships. And partnerships themselves aren't taxed, it's the partners of the partnerships that are taxed. So these are university endowment funds and pension plans that are trying to provide funds for retired folks and trying to provide scholarships and operating costs for colleges. So if the administration wants to kind of start taxing tax-exempt entities, which has actually been on the table and discussed, that's going to change our world very significantly, but it's also going to change the world of the university endowment funds and pension plans if they start to be taxed in some way. So as an oil and gas company, we're going to have a very watchful eye as far as what's going on with the tax code. It's going to take some time. So in the meantime, we're just going to continue to do what we normally do, continue to run our business, continue to invest in new energy sources until the government changes their mind or tells us not to from that standpoint. So economics works, so we'll continue that. So.
Thank you. We might, Tom and Richard, talk about how tax changes may affect the insurance industry and pricing. For instance, I know some insurance companies, including ours, carry deferred taxes based on today's tax rates. So if you reduce tax rates, there's an automatic addition to surplus at that point in time. But if nothing else, all insurance companies are C corps, so they are taxed at the standard corp rates. So if you end up having lower, it drops down to 25 or 20%, you're going to have another addition to surplus. So have y'all thought about how that might affect the operation of insurance companies, their appetite for risk, and their amount of surplus?
Just another reason I asked was underwriters to give these good clients a further rate reduction. If the government's going to give them a tax break, let's make sure we pass that back to the client. No, I think that's a great point, and quite frankly, until we know what's going to happen, there's a lot of speculation out there, but if it's going in the right direction for the consumers, the economy goes up, that's going to help the underwriters because they're going to get more volume, they're going to have more activity, they're going to have more premium coming in, and they're being taxed less. So the release of old reserves has gone on for the last few years to really augment underwriters' results. If you have what you described, Bill, happen, then their surplus is going to go up. They can release perhaps old reserves, which will further improve their results and hide some of their current losses. And so it can be really positive. But quite frankly, I haven't spent a lot of time thinking about it because none of us know exactly what's going to happen. Until we do, there's just a lot of speculation out there. But I think we need to be somewhat prepared, especially for the different industries, because you don't want to be standing by and just get run over when things change.
And there's so much surplus in the industry already. Adding to that surplus with some tax breaks, I'm not really sure what that does.
It lowers your rates.
Okay. Thanks for the clarification.
Well, it's an understatement that a lot of people are terrified about a lot of the changes going on and what might happen in the legislatures or at Congress or in the White House. But at the end of the day, there are checks and balances. And so, Julie, I'd like to have your comments about, what are the check and balances on these type of major changes we've been discussing this morning? And how is the new administration power limited? And what are going to be the major pushback points?
Well, as we've seen recently, the courts are one of the checks and balances. If you'll remember from your high school civics class, talking about the checks and balances, the courts check the executive branch and the Congress and requiring that our laws meet constitutional muster. And so we've already had one review with regard to the executive order relating to immigration. This is not unusual. Obama had challenges to executive orders. George Bush had challenges to executive orders. So this is not new or different. It is new and different that it is happening this quickly in the administration. So to the extent that the Trump administration wants to operate via executive orders, I think we're going to see a number of challenges to those. But the Congress is also a check and balance. It's really the Congress's purview to develop the budget. The president can prepare his budget and can suggest his budget, but it's the Congress that has to pass the budget. So the Congress can totally ignore the president's budget. I don't think they're going to completely ignore it, but nevertheless, the Congress can reject the budget. In the Obama years, with the budget that was sent to Congress, the proposed budget that was sent to Congress, you could expect that Congress was going to pare back that budget to something that met their appetite. With Trump's what he's calling a skinny budget that he's proposing, you can expect that Congress has to protect their programs, has to protect their districts. And so you're not going to see, I don't think, the type of massive cutbacks. For example, the cutback with the Coast Guard, it could have a significant impact to a number of districts, and that type of rollback could be quite detrimental. So I think you're going to see a lot of pushback on those type of problems. The Congress is also operating on its own, and Congress is developing legislation. And there seems to be a dichotomy between what's going on in the White House and what's going on in the Congress. So I think you're going to see congressional programs and bills that are developed and passed despite what the executive branch is doing in terms of issuing executive orders. So I think you're going to see the Republican Congress, they've got the majority, they've got the ability to push things through. So I think you're going to see them far more active. I think right now it's an organizational point of everyone trying to figure out exactly what they want to do. We've seen the debate on the Affordable Care Act, and they want to make changes, but it's a matter of figuring out what needs to happen, how that needs to happen, how to put that bill together, and how to get it through. But certainly the Congress has the ability to move a lot of this through and make some significant changes. The other thing that we have seen, particularly with the Women's March, protests that are going on, loud constituents showing up at town halls and demanding that congressmen do their job. I think you're going to see the voice of the people, and as well as the voice of lobbyists, promoting the interests of the constituents, promoting the interests of companies, promoting the interests of particular groups as to what they want their say in. We remember when we spoke a bit about Cuba, you've got the ag interest in the central part of the U.S. that heavily supported Trump. But you've also got Trump indicating that he's not supportive of a relationship with Cuba. Well, let me know that the ag interests want that relationship. They want a place to sell their excess grain. They want that market. So I think some of these things are going to have to come together, and the winners and losers that we're seeing are going to voice what they need and the changes they need to see happen as time goes on. I'm very privileged to be a partner at Holland at Night, and we have a government group that focuses on not only representing clients before Congress and before different agencies, but being involved in particular lobbying efforts. And it's a bipartisan group. We have former congressmen, both Republicans and Democrats, and we also have someone who's recently left the Trump transition team. So I think that companies and groups are going to be very active in letting their congressmen know what they want and expressing those interests. So I think there's a wide variety of checks and balances that we are going to see.
So, Richard, with your work with the CIAB, do you have an insurance perspective to add?
I'll give you my perspective. I'm not sure the official CIB perspective is, or if I should share it if I did know it. But my perspective, the insurance companies want to make a return on capital. They're there to make profit. And so some of the pushback may not come just from Congress and people in his own party, but from the insurance market and the carriers. When you try to change the Affordable Care Act, it's going to still have to be modified to the point where you're going to attract underwriters and insurance companies who want to write that business. And I think that's going to be an issue. If you look historically at the return that insurance companies have received on their capital, depending whether it's Democrats or Republicans, it's actually very close over the years. It doesn't differ a whole lot. And I think that's going to be the case here. Underwriters are going to work towards their return. We've got to keep in mind, in 1945, the McCarran-Ferguson Act made insurance regulated by the states. And so this is state-regulated business. And so you're going to have some pushback from that. And I think the other thing that the Republicans are already seeing, there's not agreement in their party. We had the rollout of the proposed Affordable Care Act revised plan, and you've got two different extremes Republican Party, two different angles. One's calling it, Obamacare light, another one saying it doesn't go far enough because it doesn't. 4 senators, Republican senators, came out and said that it doesn't protect Medicaid in their states enough because of some of the changes that they're proposing. So I think one of the big pushbacks is going to be their own party. I think Trump may have more difficulty getting consensus building. You saw in his last speech to Congress that he was trying to get consensus building. I'm not sure he'll always be able to get that. I think even with his own party, he's going to have issues. So I think it's going to take more time for him to accomplish what he wants. He's not going to be able to do it as quick as he would like. He's not going to be able to issue the executive orders to have it all done. With all that having been said, I would not ignore the power of Trump's tweets. And who would want to be an insurance company executive and have him target you and have him start tweeting you at 3 in the morning? You do not want to be there. And so, that's a lot of the unknown here of how he's going to push things through and pull people to. So I don't know if that answers your question, but I'll come back to my original deal. It's going to be interesting to watch. I think the pushback is going to be just as interesting as him trying to advance his things.
So, Tom, you're involved in the state legislatures, and, when you talk about the election, there was there's been a huge movement toward more Republicans-controlled houses, governorships, and what have you. So from an insurance company's perspective, but also what you do, what are your thoughts about the check and balances?
Well, a couple of, actually several things. I think that the McCarran-Ferguson Act is being underestimated. It's very clear that insurers are regulated by state agencies. And that is sacred in our industry, whether we like it or not, it's sacred. And if there is any attempt by the feds to dip into the territory that these 50 state agencies around the U.S. and the District of Columbia, et cetera, into their authority, there will be significant pushback. I can't imagine that fight. It's very hollow ground for these agencies, and they're very serious about their work, and they do a great job. They've overall done a great job for the industry. NAIC has poo-pooed the idea of federal oversight. NCOIL has sort of poo-pooed the idea of federal oversight. So if they dip down into things that are traditionally reserved for the states, I think the Trump administration may get more of a pushback than, I think it will be huge. Secondly, In the state legislatures, I think it's been very interesting. I monitor legislation around the country with my counterparts. We look at things, and I will tell you that from my personal perspective, the legislatures are much more aggressive about trying to bring about some change, especially as it relates to workforce issues, than I have seen in years. And they somehow seem, in my mind, they feel emboldened. And I've never seen so much proposed legislation designed to cut benefits that are delivered to the injured workers in my life. I mean, there's work comp reform in a lot of states, or work comp tweaking in a lot of states. And this follows two court decisions, Supreme Court decisions in Florida that gutted limits on benefits in that state and gutted limits on attorney's fees. And it follows the decisions in Oklahoma, where some of the changes in their benefits were ruled unconstitutional as well. So it's hard to know what to make of that, because we were kind of going down the path that we were going to see fewer limits on benefits, and now suddenly we're seeing a lot of legislation placing limits on benefits. So we'll have to see where that is. Kind of wanted to close on an interesting thought. I attended the WCRI annual meeting last week in Boston, and there was a panel discussion between two former senators. And one of the senators put forth the concept that checks and balances in our country are eroding, that the inactivity by Congress and the delegation of Congress of a significant amount of power to the president and the executive branch has really kind of eliminated Congress from that balance of power. And it's really now a struggle between the executive branch and the judicial branch, sort of along the lines of what Julie was talking about. So I haven't really figured out what I think of that, but it was certainly some food for thought and made you go, is that something that we need to consider? Are the checks and balances still in place that our forefathers really intended for us to have?
Well, it'll be interesting with the EPA now being led by someone in the energy industry, because EPA had led in bringing very aggressive litigation. The Ranger case comes to mind in Texas, that the EPA really took the lead and forced these things through. If the EPA has a different tact on that, and we're seeing the rollback of many of the executive orders from the Obama administration, it'll be interesting as to how some of these issues get to the court. We may see the Sierra Club and other environmental groups becoming more litigious and more active in that regard. And we talk about changing some of these regulations, and the state regulating and fining oil and gas companies for violations. Sometimes these fines aren't that big, particularly compared to the project. But when you're dealing with individuals who then bring civil lawsuits, there's still a check and balance there. If you still have a civil violation, you may not have an EPA reg violation, but if you still have a pollution issue, if you still have a spill issue, you still have a civil exposure that you've got to deal with. So you may be able to take back some of these regs, but it could open up to even more litigation and the courts becoming more and more involved. And certainly the courts have not been shy about getting involved and taking quick positions. It was interesting to watch the Ninth Circuit immediately review the order invalidating the immigration executive order. They immediately looked at it, they immediately addressed it, and I think we will probably see more of those kind of actions by the court. Just as an aside, if anyone is interested in tracking some of these issues, our Washington office has a website. It's called HK Law Presidential Transition Analysis Center, and there are regularly articles posted on a lot of the transition issues that are going on. So if you're interested in keeping up with some of these topics.
You know, Tom, early in my insurance career, I was told that the insurance industry would rather than deal with one huge gorilla, i.e. the federal government, they would rather deal with 50 monkeys, at the state levels. Is that still a truism? Do insurance companies still would prefer the state regulation versus federal regulation?
I think that's a truism, at least for some of the long-term legacy companies like my company, because it's a system we know. It may be difficult, it may be expensive, it may be somewhat inefficient, but there's a lot of effort at the NAIC to make those multiple systems more efficient and more user-friendly. So I think that right now that's probably the position, but I'm speaking on my behalf. I don't know if our company has a different position, but I haven't heard that we have.
Well, it certainly avoids just, wholesale changes. I mean, for something to work its way through the state system, it takes 5 to 10 years and sometimes never gets done. So I think that's a moderating influence. So from the energy side, Kevin, do you have any thoughts about the checks and balances and that make you feel maybe more comfortable about radical change?
Well, I think from our standpoint, we're trying to be prepared and react to any sort of changes and adjust our business plan accordingly. And what we've seen with all these checks and balances is a delay, right? Nothing's going to get done quickly. And so we find ourselves not having to worry about having to adjust our business plan very quickly. It takes a lot of time. And I think that's part of the process that's important, is to go through this discussion and figure out, make sure there aren't any unintended consequences that will be detrimental to business or companies. And you have to go through that long process. So the fact that it takes a long time, we should be okay with that. Because sometimes I think things get done too quickly, and then all of a sudden there are those unintended consequences, and now you're backtracking, trying to plug holes, which can be very dangerous. So again, as an oil and gas company, trying to be a profitable company, we just want to know what the rules are, know what the game is, so we can figure out what we need to do and run our business. So again, the time it takes to go through the process, we're okay with that.
Well, that's all the questions I have. Thank you all for sharing your insights. Hadn't this been a great panel? Let's give them a big hand.